Welcome back to the deep dive. Today, we are tearing into the Q3 2025 earnings for Comscore Inc. They dropped after the bell on November 4th.
And this one was one of the most confusing prints of the season, for sure.
Yeah, absolutely.
Yeah, this tiny revenue beat, a real squeaker. But it was absolutely crushed by a huge miss on the bottom line. And the market did not like it.
No, it did not. The stock dropped, something like 11% the next day on really heavy volume, too?
Swift and brutal.
Exactly. So our mission here is to unpack that. Why did everyone ignore the top line and just, fixate on the profitability miss and the guidance cut?
Yeah, is this just a stumble? Or is there a deeper, a structural problem here that management's trying to cover up with all this talk of a transformational cleanup?
Let's start with the hard numbers. Lay them out for us.
All right, so looking at the financials, Comscore reported revenue of $88.9 million.
Okay.
That was up just 0.5% year over year. But technically, it did beat the consensus estimates, so, a small win on that top line.
A very small win. But okay, if revenue is basically fine, then profitability must be where the disaster is. It sounds like the company's bleeding from somewhere.
That's putting it mildly. The GAAP loss per share was a shocking negative 86 cents.
Oh.
And the context here is everything, right? The street was looking for a positive result, something in the range of like 90 to 92 cents per share.
So wait, they didn't just miss. They missed by almost $1.80 per share.
Exactly. Even the adjusted EPS was a loss of 63 cents. I mean, when you go from an expected profit to a near dollar loss, that is just a catastrophic miss. There's no other way to put it.
And investors, they don't really care about accounting noise. They want to see operational health. So that brings us to EBITDA.
That's the real story. Adjusted EBITDA came in at $11.0 million. And that's down over 11% from the prior year.
So what does that do to the margins?
It crushes them. Margin compressed from about 14% a year ago down to 12.4% this quarter. The takeaway is just crystal clear. The company is making less cash profit for every single dollar of revenue it brings in. That's what's driving all this anxiety.
Okay, but hang on. I want to clear up one thing that seemed confusing. Management pointed out a net income of $500,000 this quarter. That's a positive swing from a huge loss last year. Isn't that a good sign?
It's a classic accounting distraction, to be frank. You have to remember that last year's number, that massive $60 million loss, it was distorted by a one-time non-cash event, a $63 million goodwill impairment.
So it's not a real comparison.
Not at all. So while, $500,000 in net income sounds nice, the real health indicator, the core operating profitability, is that EBITDA margin, and it compressed by 160 basis points. That's the number that matters.
Got it. Okay, so let's unpack where the business is actually working, because management did stress some growth engines. They talked a lot about cross-platform measurement.
They did. And they pointed to some really strong growth there. Cross-platform revenue was $12.3 million. That's up 20% year over year.
20% is not bad.
No, it's a healthy number, especially for a key strategic area. It's being driven by Proximic and the adoption of their campaign ratings product.
But this is where it got really interesting to me. Management put a huge asterisk next to that 20% number.
Right. They said that without a strategy shift from a single large retail media client, that growth would have actually been 35%.
35, wow.
What's so fascinating there is what it tells you about their concentration risk.
Yeah, the difference between 20 and 35% is just one client's decision.
Exactly. So on one hand, that 35% figure makes you optimistic about the product, but on the other, it shows how exposed they are to any single client changing their mind. And they said that headwind is going to hit Q4 as well.
That makes me a little nervous. Banking on a what-if growth rate. What about the rest of the business? What are the solid parts?
Local TV. It continues to be a real standout. It delivered double-digit revenue growth, and it's a huge differentiator for them.
So how does that fit into the bigger picture, the overall segments?
Well, the main segment, content and ad measurement, it's most of their business, right? It only grew 0.3% to $75.5 million. The strength in local TV in that cross-platform piece was basically canceled out by declines in the legacy stuff like national TV and syndicated digital.
And the smaller research segment?
Grew about 1.4% to $13.4 million, mostly from custom digital work and a new AI solution. So it's the same story everywhere. You've got these little green shoots in the new areas, but they're being choked by the gravity of the old business declining.
So if execution is this shaky, what's the plan for 2026? Management spent a ton of time on initiatives they say will drive growth next year.
The main pillar of their whole strategy right now is Comscore Content Measurement, CCM.
CCM, right. That launched back in January.
Yep. And they're emphasizing that they're now signing multi-year deals for it.
Okay, for those of us who aren't deep in the measurement weeds, what is CCM and why is it so important?
Think of it as the solution to what the industry calls fragmented measurement.
Okay.
It's built to give you program and episode level deduplicated reach. So for an advertiser, that means they can finally see how many unique people saw their ad across, say, regular TV, Hulu, and YouTube combined without counting the same person 3 times.
Ah, that's the holy grail.
It is. And they just launched a beta for it. It's critical because that's where all the ad dollars are flowing.
And this all ties into their competitive advantage, right? The certifications. We keep hearing about JIC and MRC. Why is that such a big deal for them?
This is their moat. It really is. They have full JIC certification for national TV measurement, including something they call personified demographics.
And JIC is what exactly?
The Joint Industry Committee. It's basically the stamp of approval from the whole ad ecosystem agencies, brands, media companies. It says your measurement is trustworthy.
So why is Comscore's certification so special?
Because it makes them the only player in this new alt currency space that has both full JIC certification and MRC accreditation.
MRC being the Media Rating Council.
Right. The MRC stamp means your methods are sound and your data is accurate. So their pitch to the industry is simple. We are the only independent, fully verified alternative out there. And that's a huge head start.
And it sounds like the competitive landscape is shifting their way too, especially in local TV.
Absolutely. Management was very direct about this. They expect to gain market share in local TV pretty much immediately because a big competitor is about to stop measuring a bunch of stations.
So that's just an opportunity being handed to them.
It is. And on top of that, you have these huge structural tailwinds. I mean, ad-supported and fast streaming hours are up something like 43% year over year in the U.S. They're sitting right in the middle of that explosion.
Plus, they're building the right products for it. That new AI-powered data partner network, it's all about ID-free, privacy-safe audiences. That's where everything is headed.
The strategy is sound. The products look good. The execution, though, that has to show up in the financials, which, brings us to the elephant in the room.
The recapitalization.
The dramatic capital structure cleanup.
Yes. They announced this monster $264 million deal with their preferred holders, Charter, Liberty Broadband, those guys.
And this is truly transformative. I mean, it's designed to fix a decade-long headache on their balance sheet. If the shareholders approve this deal, the benefits are huge.
What are they specifically?
It eliminates over $18 million in annual preferred dividends. That's just immediate cash flow relief. And also cancels a $47 million special dividend they owed. The whole point is to boost their ability to turn EBITDA into actual free cash flow.
Okay, so if this is so great for the company's health, why did the stock tank? This should have been seen as good news.
Because the market hates complexity. And it really, really hates dilution, especially when you pair it with bad news on performance.
The guidance cut.
The guidance cut. They revised their full year 2025 revenue to be roughly flat year over year. That's a big step down from the growth they were promising before. It just signals that all momentum has stalled.
So investors are basically saying, you want us to accept all this dilution for a cleanup, but you're also telling us growth has hit a wall this year. So where's the proof that 2026 will be any different?
That's it exactly. The entire 2026 outlook depends on this shareholder vote passing. Investors need to see hard evidence that 35% potential growth in cross-platform can actually happen and finally start to outweigh the drag from the old business.
It's that classic tension.
It is. When management is talking about foundational improvements, but the P&L shows a massive loss in flat revenue, the market is always going to focus on the operational disappointment.
This is the deep dive. And now it is time for the segment where we remind you this is all for entertainment and educational purposes only.
This is not financial advice. But given the wild volatility here and these huge binary catalysts, how would you even think about trading a stock like Comscore right now?
Well, we've established it's a trading nightmare. It's been all over the place, priced for disappointment. But it does have that real strategic momentum with JIC and CCM. And that recap vote, it's a total coin flip.
So I'd pitch a very specific, and I'll admit aggressive strategy. A volatility collar heading into the end of the year and early 2026.
A volatility collar. Okay, break that down.
The core idea is that structurally, you should probably be short this stock unless they execute perfectly in 2026.
Okay, so how do you structure that bet when you have this positive catalyst of the recap vote hanging out there?
You'd buy the common stock, the long position, to capture that initial emotional pop if the recap deal does close successfully. But you hedge it. You aggressively hedge it with deep out-of-the-money puts.
So you're basically betting the stock crashes eventually.
You're betting it crashes if the 2026 outlook, which everyone will be waiting for, fails to show real organic growth acceleration above, say, a low single-digit rate.
So you're betting on the execution risk for next year, but you're protecting yourself from that short-term jump that the cleanup might provide. It's a wager on management's ability to actually deliver.
It's a bet on whether the pain of the dilution is actually worth the reward.
That is fascinating. Okay, so to recap, we've got this transformational capital move that frees up $18 million in cash flow. You have clear product wins with CCM and JIC, but all of that is completely overshadowed by a terrible earnings miss and a guidance cut to flat. The tension is just incredible.
It's the defining story for this company right now, strategy versus execution.
And that leads us to our final provocative thought for you to chew on. With that immediate $18 million boost to free cash flow from the recap, how fast does cross-platform and core organic growth need to accelerate in 2026 for the market to finally start rewarding the company for that improved cash flow instead of just punishing it for the dilution and all these past misses?
The clock is definitely ticking on that shareholder vote.
Thanks for joining us for this deep dive into Comscore's Q3. We will be watching those catalysts very closely. Until next time, keep researching.